Okay, so we're jumping into it. Here we go. Happy New Year, Carp.
Yeah, Happy New Year.
2024 is here.
It is.
We've gotten through 2023, and today we are going to really break down, I'm going to say 5.
Yeah.
5 things you got to know about real estate going into this year, 2024. And I don't care what position you are in, there's going to be some great takeaways in this episode.
Yeah, absolutely. And I mean, I think a lot of people, you start the new year off with the resolutions, the changes, but also the unknown.
Yeah.
I mean, it's a whole new year. It's not like we're sitting at the end. We've already, like, end of 23, we were all ready to get through that.
Yeah.
You know, it's like, let's bring on 2024, but it's the start of a new year. Good things can come. Maybe bad things can come, but we're here to lay it out for you.
We're here to lay it out. And on that note, I'm going to thank everyone for either watching or listening to MLO. And of course, I'm your host, Addy Nett, and my co-host, Carp, Casey.
Yes, sir.
Once again, Happy New Year. It's good
Yeah.
to be back in. We walked into the office today. It's like, it feels clean.
Yeah, it feels clean. It's like, it's been untouched, it feels like. Everyone,
know.
takes off for winter break and holiday break, so.
And we're trying to get back into the gears. Get back into the swing of things.
Shifting gears.
Get shifting gears. I always love the, we've got Barron.
Hey, we got a third.
We got
third
the little
host.
guy. He's joining us for the first episode. Last time he was on here was a big hit. See how long he lasts.
We can do it over under on see how long before he falls asleep. We'll find out.
I would say he's got maybe 4 to 7 minutes till he starts to go into nap zone here.
Yeah, I mean, he's got the little swaddle going on. He's comfortable.
This little thing is a sling for him.
Yeah.
So he can fit in this sling, but he's actually fully.
He might need to just walk around on the top up here.
Yeah, he might get up if he gets hot. But I think right now he's looking for a nap zone.
He's trying to get this place.
He's a good little buddy.
But we got Barron in the studio.
Yeah, our little mascot.
The MLO mascot.
He's looking around. So let's jump into these 5 things because I think it's super important. There
Dude, I'm waiting for him to go for it.
He's looking around. He's like, these 5 things. You make sure, Dad, that you get the ones that I said.
Yeah, point them out.
So I think what's interesting right now, especially if we just review what happened the last 6 weeks of 2023, we saw a lot of media breakthrough on interest rates. So just to what do you say? A refresh really quick.
Yeah.
You did see the Feds announce that they are going to reduce interest rate hikes moving into 2024, which is huge. And just a reminder, so how it works with mortgage interest rates, now they're different than what the Fed constitutes the baseline interest rates are. So the Feds control what the interest rates are for banks and the government to lend to each other. So it does typically follow suit to mortgage and real estate, but it's not this for that perfect down to the T.
No. That's the Feds when they're changing rates, hiking or lowering.
Right.
It's the federal fund rate, right?
Right.
And then, those mortgages will sometimes follow suit, but it's not always guaranteed.
And I think, I can't believe he's getting up on
Yeah, look at this. It's his first time we get to see the full body on him. Look at the size of that guy.
Come here. So I think it's important to at least reinstate that, because a lot of the times we will see Google News or Yahoo Finance, the Feds rate this or announce this and that, and they think that directly impacts their pre-approval status, their refinance opportunity for mortgage rates. So as the first thing Carp and I put together was, be mindful of the difference between the national average of a mortgage rate and what the Feds are saying.
Yep.
Though they typically and traditionally follow suit, they're not exact, and it's not always, it happened this morning, so it happens now.
Yeah.
Additionally, I want to say, be prepared in 2024 for a potential volatile interest rate market. And what I mean by that is ups and downs. So maybe the best analogy would be, a lot of people look at cryptocurrency as a volatile investment. Right. Meaning, 10% gain, 5% loss, 20% gain, 2% loss.
Yeah.
Versus maybe more conservative investments like CDs, where it's just like 2% yield flatline.
Yeah.
Right. So I think this year, and we'll go into why, we're going to see a lot of ups and downs. And then we're going to continue to see different media skew the reality to the consumer based on the election year.
Yep.
That's number one, right? What would be number two?
Well, I mean, the year's going to change because you're going to start it off right now with a certain presidency, right? And then you're going to go into it. But between all of that, you'll have those different changes. Like the media's already put it out there, you know, almost like it's guaranteed that we're going to see all these rate hikes. That's not or rate cuts, sorry.
Right.
So, you know, cutting those rates, lowering the interest rates. But that's not guaranteed. That's just a predicted forecast that could potentially happen, but that's not guaranteed. Like their media has talked about maybe 4 to 6 rate hikes. Maybe or rate cuts. Maybe we'll only see 2 rate cuts, right?
Right.
So that's where that volatile market can come into place, because we might have a month where you see interest rates start to come down.
Right.
But then we have a month where they maybe tick back up.
I think one of the biggest indicators too to keep, especially in quarter one, if we're talking, and I'm sorry we're getting like jargony and long-winded on the rate thing, but I think it's important. You have a couple of factors like the CPI, Consumer Pricing Index. So that's a funnel that really will determine inflation rates. So if us as Americans and consumers are willing to pay X amount for something, it drives the price up, right?
Yep.
So we're exiting the highest spending part of the year, which is the Christmas season. So it's possible when those spending figures hit the Fed's review or whatever, we might not have as positive of we need to reduce interest rates because they're looking at older data.
Yeah.
Right? So that's something to be mindful of.
Well, it's a good point, because they are looking at it in the rearview mirror.
Right.
You know, when they come out and analyze stuff, it's like in that first quarter, they're really kind of looking at that fourth quarter of last year. Right. And
I think that's important because that's a scenario that could play to the volatility of interest rates.
100%.
So if we're cooking at a good rate and then all of a sudden that data pops out, the Feds are like, whoa. We're in a potential danger zone of inflation going up because they're referencing consumer spending from Christmas, right? And then you see interest rates go back up. That's confusing to the consumer who sees, election, rates are going down, this or that.
Yeah.
I'm going to get pre-approved with my mortgage advisor. The mortgage advisor says they're good up to 500. Then we see that data come out, rates spike up 1/4 to 0.5% higher, which reduces their pre-approval amount down.
Yep.
You could have those scenarios all the time. So I just want to be like super over communicative of that potential scenario. And I always tell people like, hey, this is why it's important to get ahead of the planning process and work with someone that's going to manage your expectations, is going to show you the different variables. Hey, we're at 6%. This is what happens if it goes to 5 or goes back up to 7. You need to understand that. Additionally, the tip and the takeaway is always rerun your numbers before you ever start a huge session of looking at homes. Like, hey, I'm going to go look at 12 homes, 20 homes in the next 2 weeks with my realtor. Have a touch base with your lender, make sure there hasn't been any big changes, right?
Yeah.
And then most importantly, before you write an offer, man, have Carp and I run those numbers for you.
Yes,
Hey,
please. Because going out there without knowing that stuff is, one, it just causes anxiety for you as the home buyer, because I mean, I think a lot of the questions I've been recently getting too is you know, people don't have a ton of excess money, right? So they have their down payment and they have, you know, enough for closing costs, but maybe not an abundance left over. So a lot of it's been, you know, hey, what is, you know, the total cost to buy this house look like? Like, is it your down payment plus $9,000 in closing costs, or $10,000 or 11? Because they only have an additional 12 or 13, right?
Yeah.
And so knowing those numbers up front is crucial, and it allows you to just go out there and then kind of freely shop. You don't have to sit there every time a new home comes up. Well, can I afford this? Or what's the payment on this? You know, so key.
Yeah, I love that you brought that up, because I think one thing that consumers don't really understand, especially over the last year, and what I think this year with continued volatility, is how much that does impact the total closing costs. So one thing to remember with interest rates, right? There's a national average interest rate, which is going to take into account to all the lenders in America, you know, for an average, right?
Yep.
Now that average right now, 2.5 years ago, that average interest rate had no additional closing costs to lock and secure that interest rate. Now you're seeing about, I'm going to conservatively say, about a 1% average cost added to your closing costs.
Yep.
That's a lot.
For that rate.
$500,000 loan, that's $5,000 in additional closing costs just for the average rate.
Yes.
Now, hey, Addy, how do I get rid of that and reduce my closing costs? Not a lot of people have gone that route because they haven't had the option. It either just isn't there with banking institutions, mortgage institutions. But most of the time in the recent months, half year, quarters, sellers have been contributing to these closing costs, and it's been absorbed and not necessarily an out-of-pocket expense, but also buying down the interest rate. So now you can get a lower interest rate and increase that cost. I think that's really, really important. And the reason why is you'll get a lot of lenders, real estate agents, people in our industry kind of inflating the urgency of interest rates to drive leads and business opportunities. And I'm not trying to be negative, but I think it's important to know where it's like, oh, if you see a social media post from somebody, oh, interest rates are at 5.999, they might really be at 6.5, but from their disclosure, they're going to charge you 4%. 4% additional closing costs, which is massive. $20,000 in closing costs. Not many people want to do that or have the wherewithal to do it. And most importantly, all those people who are like, hey, I'm not going to buy or sell, I'm waiting to refinance. This is where Carp and I do a really good job, because it's all about break-even points of your initial investment on the original loan. So if you got in at, let's say, 6.5% and you paid $10,000 for that original rate, you have a longer wait period from a financial perspective, because you already forked over 10 G's, $10,000 for that 6.5.
Yep.
So if you refi at 5.99, you're washing away all that upfront cost to start over your 30-year mortgage. And once again, to my story before, be mindful that lenders will also promote you paying points on the refinance. So if the real key is, I always tell people, you want to wait for a reduction of a minimum of 1%. 1%. So if you started at 6.5, don't look at it until you see that national average at 5.5. And I might even bump that up to 1.5% weight.
Yeah.
So I just think it's important, because there's so many people out there who are chomping at the bit to refinance, and I totally understand that. Like, you see huge reductions in their monthly payment when they do so, but you can really stub your toe if you early refinance, because you might do it multiple times.
Yeah, like, I mean, a good example is, 2020, 2021, right? Rates were coming down, and I had one client that decided to go against that kind of good advisory. Because the idea is you want to try to refinance one time. You want to try to hit that at the right time, at that low rate, where we think maybe, the rates have bottomed out and are going to kind of be there. But I had a client, every time the rates were going down, and you see it in the market, see it in social media and the news and all that stuff. Like, okay, rates were at 8.5, and now they're national average of 6.7 or whatever, right? And so they're like, in their minds, that's 2% lower. It's time to go. They pull the trigger. And then here we go. Let's just say 6 months from now, they're at a 5.7
again.
And they're pulling that trigger again. And then, the idea is, well, let's just say they went to 4% for a final kind of playing field and leveled out there. Well, guess what they're going to do? They're pulling the trigger again, because we keep going back to that. Remember that analogy of John at the barbecue, who's got the lower rate. But every time you guys are refinancing or doing a mortgage, you're paying costs on that. Right. And so it's like you have to outweigh the savings versus the costs. If you're spending $5,000 every time to save $200, it takes a little bit to recoup that $5,000 back.
Right.
And so that's where it's like, don't get ahead of the game. you know, on a refinance, I think the key is being patient in the timing and waiting for that, right?
Patience is key. And then and I don't want to turn it into a refi conversation, which I ramble and could do that really quick, but there is a difference in the interest rate you get if you're doing what's called a streamline or interest rate reduction refi versus a cash out refinance.
Yeah.
So that's another thing, guys. If your whole plan is, oh, I'm going to let rates drop, I'm also accumulating all this credit card debt because my payment's so high.
Yeah.
I'm just going to wait for rates drop, and then I'm going to pay off all the credit card debt by extracting my equity. That's a totally other scenario. You're not getting like a paper national average interest rates on a cash out refinance. So understand there's different adjusters to the interest rate as you pull out money. Ideally, you do not want to pull out your equity if you don't have to. Now, obviously, there's situations, we've heard them all in a decade in this industry, but those are things to be mindful of. I think we've hit that point really well. The volatile market interest rates. My biggest thing is I just don't want people to be swindled via social media. It's really unfortunate how many desperate people I see like coming up with the newest, like I did this, do that, blah, blah. Totally. Even like celebrities be like, the minute rates drop, the floodgates are going to open. And sure, trust me, my income's totally dependent on a thriving real estate market. Do I want that to happen? Absolutely. Yep. Do I think it's going to happen so fast that I can't even? No, I think it's going to be very gradual. And I feel like the feds do kind of have their hands on the harnesses here. But you will see an acceleration trending in the right direction. Just not as quick as the media is likely going to.
Yeah, it's not dropping off a cliff.
So our number two biggest thing about 2024, and I made just a broad note on my agenda, is financial awareness. So I think, what's super important is trending in January. Everyone's talking about like, oh, I'm going to do this, your New Year's resolutions. It's so important right now, especially going into an unknown market, a volatile market, to have a grasp on your credit score and your credit card balances. Credit score plays a huge factor into what interest rate you can get. Higher the credit score, lower the interest rate, or lower cost for the same rate.
Yep.
That's super, super important, guys. And I see a lot of people, particularly first, second time home buyers, there's so much emphasis on like, I need to get 20% down or 10% down, or I won't do it till this, but they let their credit slip.
Yeah.
Credit plays just as much as an impact as down payment, if not more. It's really, really important. So going into this new year, Casey and I had wrote down, take an hour, maybe even 30 minutes to review all your accounts and build out your budget. Do like a financial oil change and audit yourself.
Yeah.
What are some examples you've told people in terms of just reducing their overhead and what they're spending?
Yeah, well, when the market was good in 2020, 2021, inflation, was, not rampant at that point yet. Money was flowing through the economy.
Yeah.
And so I think, a good point is a lot of people kind of got carried away with things. You probably got new cars because the car rates were pretty low then.
Oh, yeah.
You probably added on a bunch of little other things that, this is where I point out to like clients and borrowers, like extra costs and subscriptions and certain items now that you can probably cut back or reduce, right? Like I'm sure everyone's got probably 5+ streaming accounts.
Yeah.
Maybe look at only having maybe 1 or 2. Cut that back a little bit. Those aren't a drastic savings, but over time, that might save you maybe $1,000 over the year, right?
Totally. It's like a bunch of little decisions compound into one huge impact.
Yeah, great way to put it.
Yeah.
If you make small decisions, right? Because it's not like, ideally, it'd be great if you could just cut out a cost that saves you $500 per month, but most of the time that doesn't happen.
Right.
So you need to look at some other ideas on the way to do that. And that might be just a smaller cuts that's a $25 per month cost you have going right now. Maybe look at cutting that, maybe cut a few of those. And now you're up to maybe $100 or $200. It doesn't seem a lot, right? But over time, that could get you there. If you did that, I mean, that's $2,400 in your savings over the year, right?
It's huge. And like, we're not licensed financial advisors. These are just things that both of us have done personally and found success with, and seen other people either make good choices or bad choices. One of the philosophies that, or mind kind of altering approaches, in my opinion, is to start looking at things at like times 12 for 12 months out of the year. And if you don't like multiplying things by 12, and it's much easier to times it by 10. So if you've got a $50 a month cost, times that by, add a zero to it. That's $500 a year. Start looking at everything with an extra zero on it.
Yeah, good point.
And nobody's perfect. Like, I spend money on little things and vices that I probably shouldn't.
Yeah, me too.
But I also kind of, I supplement it with other things, other decision-making processes. Like I remember having, this was before the pandemic, when we would commute into the office on a regular basis, how much money I was spending on like getting a coffee on the way to the office, getting a snack, or eating out to lunch. And like, obviously doing those things from time to time are fine. But if you start looking at those at 10 times a month, times 10 months to 12 months out of a year, holy cannolis. Like, a $5 coffee 10 times a month is $50. Times 10 months is $500. That little tiny habit is a huge game changer, rather than parking $500 into a savings account. Or if there's two people under a household, that's $1,000 a year. That's $1,000 3-day trip to, you know, the lake house that you could have done.
I mean, right? In a weekly breakdown, if you're driving every day, you know, to work, right? You have gas. So we'll just call that a clean 100.
Sure.
You know,
clean hundo.
Clean hundo. You're getting your coffee. Mm-hmm. You know, even if that's $5 every time, and let's just say you only get 3 for the week. Okay, there's 15. You go out to lunch, maybe. Let's just say you go out to lunch twice.
Right.
We're gonna call that 40. You're at $155 right there.
It's so crazy.
Just a week.
Everything adds up, and I think, you know, and I'm not trying to sound old.
And that's on the low end, because you know they're getting coffee every day and lunch every day.
Total. Well, and just like,
so that's more like $200.
It feels like everything's so expensive. Like, especially food and service industry related things. Like, I don't want to beat the horse, but budgeting, super important. Multiply your purchases daily, weekly, or monthly. Do use the 10 factor. Add a zero to it, and before you decide on it, be like, okay, is that worth it? It's interesting how your brain starts looking at stuff differently and money differently if you apply that times 10 approach.
Yeah. Because it's easy to slide the card or pay the cash when it's like, oh,
just not worry about
it. $20, right? Like, oh my gosh, it's $20.
Another quick audit too is back to the credit cards. Like,
good point.
Do everything that you can to reduce those balances down. You know, credit experts and people that work in that space full time say that your credit card utilization ratio, in order to get the backing up, credit card utilization ratio is the balance relative to the limit of the card. So if you've got a $10,000 limit on a card and your balance at the end of the statement is $5,000, your credit card utilization ratio is 50%. You've used up half of your limit, right? So credit experts say that in order to get the most amount of credit points, it's a lot of different factors, but just specifically the slice of the credit pie of credit utilization. Is you want to be in single digits of your credit utilization ratio. So under 10%. Once again, $10,000 limit, you're wanting to keep that under 10%. Now, not everyone can do that. Life happens. You get paid at certain times. You need to put this and that. It's nothing to freak out about. It's tier leveled. So it go like 10, 20, 30% is probably the green light okay zone. The minute you get over 50% utilization, if you don't have a diverse credit history and other positive compensating factors, you can see a nosedive. So when Carp and I talk to people, it's like, oh, what do you think your credit score is? And like, oh, it flutters between 680 and 740. We know right off the jump that's someone that's got this huge volatile swinging of credit card balances. So going back to our tip of like, hey, focus on credit, we want this score to be as high as possible. So work toward that credit utilization ratio. Lastly, I'm sorry, folks, if you are the person that's paying minimums on your credit cards, and instead of paying that balance, you're putting that money in your savings account. That is not saving money. So if you owe $30,000 in credit cards and you have $20,000 in your savings account, you're negative 10 grand. Yep. You have not saved $20,000.
Yeah.
We're chuckling,
that's a great point.
But people do that all the time. I've worked so hard. I've saved up 10,000, 5,000, whatever it might be. That's a lot of money. You haven't saved. You deferred your debt.
Yep.
That you're paying 20 to 30% APR on. That's not savings.
We call that a negative 10 grand net worth.
It's just, I'm not trying to be mean.
No.
We've all done it before because it's like this mental game. You look at your accounts, you're like, oh, I got this. I feel really good. Oh, I've got $1,000 balance on this card. I'm only going to pay $500 of that 1,000 because I feel better with 500 in my savings or my another. No, like, don't do it. Get into the habit of just paying it down. And it's not everyone can do it, but we see it so often where people think that not paying their bills and just keeping that money is saving money. It's not.
Yeah. And I mean, most importantly, just, make sure you're making the credit card payment.
Yeah.
Because not making that is even a whole different drastic feature on your credit, just try to never be 30 days late. If it's the only minimum you got, make the minimum, but ideally you want to try to be paying that down. So if the minimum's 35 and all you got, you can do the 50, then do the 50,
Do the 50.
And get that thing going. But the reality is, guys, like, it's been a high cost year. Right. The last year is high cost. You're going to see, I mean, I don't know where we're ranking at, but I would say the credit card balances and debts in the country are probably some of the highest times.
Record high.
Yeah, record
just
high.
Hit over $1 trillion nationally.
Yeah, see, so... And the reality is, and you guys have felt it going to the grocery store or buying any kind of goods these days, it's just the costs don't outweigh the incomes being earned. So there is a gap there, and that gap is being filled with credit. It's just, that's the reality of the situation. So we feel for everybody out there with high credit card balances or just, because it's stressful. It's stressful when you're not making enough money to cover or get ahead, right? And I think that's been most of the economy in the last year. It's been a lot of people in real estate too, because the market's been down, right? But you got to have that mindset of positivity and knowing, hey, you're going to get through this. It's not ending tomorrow.
Right.
We make our payments, make them on time, start to pay a little bit more, and it's going to shift back in everybody's favor. You just gotta kind of weather that storm and get through the grind, but don't just give up and collapse and just keep sliding and just not keep proactively thinking about the positive things, right? Yeah. Do the times 10, maybe give up some of those things. It's kind of time to hunker down a little bit so you can get ahead again and then be okay.
Yeah, I love that. I love your message there. I love the vibes on that message too. One thing that I've noticed, and I think you could probably agree, we've obviously worked together for a long time. You see it a lot in our industry. And I'm not just saying it's people in our industry, this is kind of an American culture thing where it's like every time someone has a good month or gets a raise, the majority of people upgrade everything in their life and they upgrade their monthly overhead costs. I see that so often. It's like, oh, I get, a 10% raise. I'm going to go get that new car. I'm going to go join this country club, or I'm going to join another overhead thing or buy this. And they stacking on more minimum payments rather than my philosophy is let's keep the minimum or my monthly payments to an absolute minimum as humanly possible. But the reward would be an activity, a one-time cost rather than a monthly. That's where you can make a huge hurdle mentally and financially, financial strategy is like, okay, yeah, I would love to get rid of my car and get a brand new car. That feels good, but my monthly payment would double. Well, what could I do differently? Could I go on a trip? Could I buy myself a new set of golf clubs? Could I treat myself to a 2-day trip to the beach with the wife and the kids or whatever?
Yeah.
One-time costs are fine, and it's a reward. But most of us want to showboat and keeping up with the Joneses and continue to upgrade. So if you continue to increase your monthly overhead and the income flow is up and down or good or bad, you can get into a tough spot real quick. So just that's another tip that I've used personally is like, you can reward yourself with a one-time decision rather than a monthly cost.
Yeah,
really
that's
good.
Such a good point, Addy. I mean, how many people do that? And then at the end of the day, like that, that good feeling that you get when you do the purchase, right?
Yeah.
Because that's a real thing. People, it's like a drug addiction sometimes for some people, like a new purchase feeling. You get a high and a rush from it. But then what happens after, like, it's done? Like, it's not like you're still, once you've upgraded that car,
right?
After a year of owning the car, it's just a car.
It doesn't smell new anymore.
Yeah, it's just another car, right? But you've locked yourself into a 5-6 year payment plan on that.
Yeah.
When, how good does that, vacation to Hawaii? It's really good for the whole time you're there, for the most part, and then it's kind of done. And by the time you're kind of on that last day, you're ready to go back home.
Right.
And that's a one-time spend. You go back into the grind. Like
it's so funny too with like those types of like one-time trips, and we're getting off agenda, which is fine. But like, how many times have you had like a cool trip with the guys or the family, and you think back on those memories and you smile and you're like, man, I'll have those memories for life. Not once did I lay in bed or daydream about, that time I bought that car. You don't sit there and think about that stuff.
Never.
Right?
Never.
It's just, it's definitely a mind shift thing. It's like something I noticed about myself, especially from like the early to mid 20s to now, like approaching late 30s. Yikes. It's a good mindset thing.
Yeah. If anything, people look back and they're like, man, I should have kept that older car.
Totally. So I think that's important, and really padding that into like getting to a point where you tackle, hey, I got to tackle my credit card debt. Next, I need to save money. Because there's so many people too that come to me like, oh, Addy, I want to pay off, or I want to pay my 30-year mortgage down in 15 years, or I want to do this. And they're like, how do I do that? And I always explain to him, Casey, is like, look, we got a couple other benchmarks we want to focus on first. Like, number one, do you have credit card debt? Got to tackle that before we talk about paying your house off early, right?
Yeah.
Do that. Are you saving for retirement? Number two. Number three, do you have what's called reserves? If you lost your job, could you pay your bills? And if you can, how many months can you go? The target suggestion we hear from a lot of financial advisors is to have 6 months of your overhead in reserves, not invested in Bitcoin, not invested in Tesla stock, but in a savings account, preferably yielding a decent interest rate. So those are your baby steps right there. Now, then Casey and I get this all the time. It's like, yeah, so I want to buy a new home, but I don't want my payment to change. I'm really sorry, folks. There's no way anyone is going to sell and buy a bigger, newer home and upgrade without increasing their payment. The interest rate's higher, inflation happens, everything's more expensive. That's not happening, folks. So you got to, and I'm not trying to be negative, I'm trying to be a realist here. Because you'll get people who are like, oh yeah, we'll make that happen for you. Just, you're approved up to X amount. Go out with your real estate agent, find a home, and they don't know what they're getting themselves into. So have that consult with the advisor. Know you're going to increase your payment if this is what's best for you. And then Casey and I always tell people, let's say your current overhead is $3,000 a month. You talk to your advisor, your mortgage person gets you pre-approved, you go through the numbers, and the reality of the situation is what you're looking at is an increase from $3,000 to say $3,700. Let's just use that, right? That's a $700 a month difference. What Carp and I always tell people is start now. I don't care if you're a year out, 6 months, or 2 years. Start saving that differentiator.
Yep.
That's unnecessary complexity. That increase from $3,000 to $3,700. Save that extra $700 into a savings account. Don't even have it in your checking. Force yourself to get used to having that reduction of cash flow and that increase of cost, and see if the shoe fits.
Yeah.
See if you can do it.
Yeah, it's a great point. Or if you're already making the $3,000 mortgage payment, make it $3,700. You know, paying off faster, $700 to principal, but now you're making that payment to try to get used to that payment.
Yeah, and it's just normal.
And it becomes normality. Yeah,
that's like a lot of first time home buyers is like, when I talk to them and they're like they're at that point with that hurdle that they just can't make the jump because they're paying $1,600 a month for their 300 square foot studio, right? And like, oh man, I'm going to be jumping to $3,000 a month. That's an intimidating jump. Is. Start by doing that, putting that money aside and pretending that you have that overhead. And it goes the same for second, third, fourth time home buyers.
Yeah.
Because it's just, folks, it's not going to happen that you're going to have the same or less. The only ways that happen is if you relocate to a cheaper market. That's one way.
Yep.
You sell your home, you make a bonkers amount of money off the sale, and likely then moving to a cheaper market. It's not going to happen. And then most of the time, I'll run the numbers with people, and they want to put $250,000 down, and I actually show them, hey, well, let's put 100, and then take that other 150, invest it. This is how much money it would make you monthly, annually, and you have access to it. Anyways, I'm getting super off, but the forced savings things to get used to the higher is a really good trick.
Yeah, 100%.
Any other add-ins on the financial thing? Well, this is a long episode.
Yeah, I mean, really, it's just. I mean, honestly, I've seen a lot of people also pick up part-time jobs and just become grinders at this point. You know, you have a job, you're working 5 days a week, and obviously the situation's different for everybody, but. I mean, it doesn't hurt to pick up something for the weekends too. You know, go grab a part-time job. And I mean, now's the time to kind of put it in. So, that could help you actually get ahead on maybe some credit card paying off. That help you get ahead by putting, forced savings in the bank because you're relying on that one paycheck that you get for 5 days a week. And now you have another separate bucket of income coming in. From some weekend work that you're doing that you could force feed in. Really, I think, on that, like if you can create some other way to have a secondary income funnel coming in or multiple, can kind of help you get out of maybe the situation right now that you're stuck in with just the single income. So that, I mean, start looking at all the stuff you got. I'm sure you've collected a lot of stuff. Sell that thing on Facebook Marketplace or something, I'm sure there's some money to be had there.
That's a good point. I too want to go back to doing your own personal financial audit.
Yeah.
Because let me give you a quick example. So I have a friend who's picking up a second job on the side to pay for things until things get better. One particular financial habit I know my friend has is the dreaded coffee addiction.
Oh, yeah.
And we all have our vices, right? We have things we waste our money. And I'm not trying to pay. I'm not exempt from this category. But the coffee one's really easy because this particular person goes to their coffee establishment twice a day at $5 per coffee.
Is this one of those national ones or is this a local coffee?
It's a local.
Okay, nice.
So $10 a day, 7 days a week, $70 per week in coffee, times 4, $280 a month in coffee. Then the side gig is $20 an hour. Pre-tax, $20 an hour. In order to pay for that coffee, that individual at $20 an hour, and I'm not accounting for taxes taken out, would need, what's the math? $280, that's 14 hours per month. They would need to work. That's 1.5 days a month. They have to go to their secondary job just to pay for the coffee. 1.5 days of your 30-day month is spent to pay for the 2 coffees you're getting. So to me, my brain works with, well, I'm just going to make the coffee at home and have a day and a half more in my month for myself.
Yeah, absolutely.
So
I got to get them on the K cups.
But if you can find 1, 2, 3, 4 of those little examples between a couple or a house,
you
might be able to find not needing a second job for a week.
Yeah,
so I'm flipping
absolutely.
the script.
Yeah,
Say
absolutely.
you're exhausted. I can't do the 2 jobs.
Well, working 7 days a week.
I'm working 7 days a week. I'm working full 8 hours at this job. I'm coming home, taking care of the kids, getting them to sports, doing this. They need this and that and that. Then I'm working a night shift.
Yeah.
Find a week from reducing the spending or spending differently.
Yeah, absolutely.
Right? I think that's powerful math. A lot of it's because people, I think there's a lot of amazing, hardworking people.
Oh, yeah.
Amazing, hardworking people, but they've fallen into the routine of what consumerism is. I just need to do this. I need to get a new this. I just got to go get that's a part of my routine to go to the Starbucks or, you know, oh, this piece of clothing is a year old. Got to get rid of it. Or I need a new this. I need a new car. 2 years, lease is up, new car. So just interesting math there, right?
Well, yeah. I mean, I think you get stuck in the everyday of your consumer life.
Right.
And, you know, it's hard to change habits.
It's
hard. Very hard to change habits. But you're just gonna have to in this time, in the day and age. You know, we're just at such a high cost living that you got to look at those habits, and you know, then if it's not for you, then you got to look at some other ways to make up for that. Because
so I've told this story before many times on our podcast now for how long we've been doing it. When I was first attempting to improve my credit and actually like worrying about money, I got like my very first real credit card, like, hey, I'm going to do the right thing here. Not like the first couple burner cards I got when I was 18 and you rack them up and then they go to collections. Yeah. Like hey, I'm going to fix my business here. I'd swipe the card and then I'd sit in my car and I'd look on the banking app and I'd see it post. And then I'd pay it. And it sounds like super like paranoid. But what that kind of built for me was this comfort level with my bank account. I know personally, I have financial management in a good spot for me. And I'm not saying, oh, I'm making a lot of money or not. I know I'm in a good spot when I'm not fearful of opening up my accounts and logging into them. Yeah. When I know I'm swaying is when I don't want to look at them. Yeah. Check yourself on that. And I think that would be more consistent with a lot of people than you would think. Hey, if you know you're making good decisions, you feel comfortable. You're looking at your checking. Oh yeah, that's what I spent. That's tracking. I feel good about that number because you're making good decisions. It's almost like hiding from your parents when you know you didn't clean your room. Yeah. If you've cleaned your room, you're looking in there. Hey, look how good that looks. Nice. Chris sheets. I got all my toys put away. My clothes are hung. But if you got a messy closet, you ain't looking in there because you know it's a mess. Yeah. So check yourself on that.
That's awesome.
Hopefully the way I put it.
Yeah, that's a good analogy. For sure. For sure.
So let's go into like our final little bucket. And thanks everyone for bearing with us. I think there's some good takeaways. Yeah. We straight into some more like kind of mindset things, which I think is good for this year going into the new year.
Yeah, mental health.
So I think another thing to put on, this does kind of like bridge over to what we're talking about, but timing is always challenging in real estate. A lot of people are sitting back. I was like, hey, I'm just going to wait for rates to go down. I'm going to wait for this. So be mindful. Casey and I've talked about this before. As interest rates go down, demand goes up because more people are qualified, right? So just note, as interest rates slowly go down, which we think they will gradually reduce, that demand will gradually go up. So I think if you are in a personal situation where, hey, I need a couple of these things. Number one, if you are in need of the seller to pay your closing costs, right, Casey? Yes. If you need your sellers to pay closing costs, you want to accelerate your buying sooner than later. Because as the demand goes up, the sellers have more options and they don't want to take money from their profit to pay for your closing costs, leaving just the people that have their big down payment and paying their own closing costs as the winning bids. So if you are an FHA loan, which is typically 700 credit score or lower, and maybe have a past bankruptcy, or you're an eligible veteran that earned the right for that VA entitlement, now would probably be a better time in the next 3 to 6 months to go ahead and try to get into a house before the demand increases. Because we wouldn't want to see those people get washed away in the tide. And you're like, oh man, I did everything Addy and Carp said, but I waited. And then now my particular offer and best foot forward isn't competitive.
Yeah, because as we see like the market shift and, interest rates hopefully keep coming down. It's just going to bring more people into the market.
Right.
People that have been waiting, people that have been saving. And as you get higher demand, it's just going to either drive costs up or at least give those sellers more options to choose from.
Yeah.
And if you're needing some help, they might be willing to help you right now, but 6 months from now, and now they're getting 3-4 offers, maybe they're not engaged to help you. Ideally, right now, we're still seeing a lot of contracts me and Addy are getting with sellers, helping the buyer in some way, shape, or form. Maybe it's a little bit of a credit to help with the closing costs. Maybe it's all the closing costs. Maybe it's some rate buy down stuff like that. Like, they're still incentivized right now to help because they're trying to still sell their house. Yeah. And I think the average house right now is still on market for like 90 days or something like that.
Yeah.
And, they don't want to sit there and do any more price reductions, but as the market changes, as more buyers come into it, you're going to start to lose that buyer power, to try to get any help on that. So I think, now's the time. And you just said it, I think 6 months is kind of that run window you're going to have for those type of buyers that probably just have a down payment and do not have, the additional funds.
Yeah. And I'm going to add too, we were chatting about it before. Have a reality check with inventory. So in inventory, it's the amount of houses on sale or on the market for sale, right?
Yeah.
So the thing to understand is you might be looking at a lot of inventory and don't expect a whole lot of sparkling, clean, perfect looking homes. And here's the reason why. So let's say you bought a home in the last 5 years or refinanced at the very low end. You're sitting there with a really low monthly payment and you can't sell and go buy a new one because you don't want to lose that low payment. So what do you do if you're a homeowner? Over the last couple of years, you've been doing home improvement projects. You've been investing money on maybe a kitchen upgrade, right? Maybe you redid one of the bathrooms. Maybe you landscaped out the backyard and got that nice little waterfall decor thing going and the pavers and painted, a new roof, maybe a new HVAC system, all those things. So when people are handcuffed and can't move, they invest in their home. So then until interest rates really drop and you start seeing more demand and more movement, you're only going to see distressed properties. And the reason why is they can't get top dollar because they're having to give closing costs. They are sitting on market for a really long time. They're doing price reductions, right? They can't invest in the home.
Yeah.
They're bare bones. They want to get out of it. They're investors or they're having financial hardship or they have to relocate. So you're not going to see a lot of sparkling, perfect resales this year, in my opinion, because of that scenario. A lot of people are invested in like, hey, I put $30,000 into my home in the last 2 years.
Yeah.
And I'm not going to put it on market for 10% less than what I think it's worth.
Right. All
to increase my monthly payment for a worse house. So you just have to be prepared to do a little TLC in, I think.
Yeah, absolutely. And I think you're seeing, didn't you mention you're seeing a lot of listings terminate? Yeah,
one of my trusted partners, Heather Listy, was telling me, she's like, she got 35 Redfin emails over the weekend of all terminations, meaning a house went into contract pending, and then out of the blue, it terminates, it goes back on market. Traditionally, the consumer thinks something's wrong with the home, crack in the foundation, or this, that. So a lot of it isn't that. What happens now is your entry point of the mutual acceptance between the seller and the buyer is like, great, we'll buy it. You listed it at $550. You've price reduced over 90 days down to $525. My clients will take it for $525. Plus, you got to give $20,000 for my buyer's closing costs. It's a very common scenario right now.
Yeah.
So that net figure is the sellers are making $45,000 less than when they started this whole monopoly journey, right?
Yeah.
So then we go into inspection period. In a hot market, the inspection's almost a carpool walkthrough. Like they a lot of times said they won't ask for repairs that exceed X amount of dollars. Now it's cut through. They go into every nook and cranny, check the systems, check if there's any mold, moisture, roof, life expectancy, all these things. So at starting point of mutual acceptance, they've already reduced a net of $45,000, and then buyers are going back like, we need 20 more grand of repairs done. Right. And the sellers have a thresh point. They're like, screw this.
Yeah.
No, we're terminating and going back on market.
Yeah.
Seeing a lot of that right now.
Yeah, and you're seeing a lot like, I got a friend's parents that, they've had their house listed for, probably 90 days or so, maybe even more, and have already done a price reduction, a decent one. Let's just say it was 525 and they went to 500. And, they're getting kind of just tapped out of that because, I think they're exhausted. The agent, I think, now wants them to do, offer up closing costs as an incentive. And, the goal is still to always try to get the home sold and, get a good buyer in. But at the end of the day,
they got to buy something
They got to buy something else. And they're not trying to walk away with no profit made. I mean, the whole point to sell a home is to hopefully try to make some money on it. I mean, so
you got to remember that.
You got to remember that.
They got a loan to pay off. They got to go somewhere. Even some people, like, this is their retirement. They need this money. They're relocating to a cheaper market with lower cost of living, and they need that X amount of dollars to live on.
Yes.
So sometimes there are breaking points for sellers. So once again, we're not trying to be negative. Like, going into this, these are things to consider and to understand. I think to recap that final segment, land the plane, if you are dependent on the sellers for closing costs, if you are in a compensating loan program like an FHA loan, or if you're trying to do a full zero down and that is your goal, you might want to get into the self-checkout lane and not wait. Like, hurry up and get there in the next 4 to 8 months, 8 being the absolute latest, because that would be pressing up to election period.
Yeah, absolutely, buddy.
I love it. Well, Happy New Year, Carb.
Happy New Year to you.
And we want to thank everyone once again for another fabulous year of following. The reach outs, the comments, direct messages. We really appreciate it. And we're striving through and excited for a revamp here in 2024. If you need any help, you want to set up a Zoom with Carp or myself, you wanted us to do an episode of which might be a certain title, you need to get pre-approved, you got to hit us up. Let us know. Shoot us a text. Shoot us an email. Hit us up on social, whatever is most convenient for you. We absolutely love helping people make the right strategic plan for their journey in real estate. And on that note, I will thank you all for watching or listening, and we will
catch you later.
Yes. 1 of 1 this year.
Nice. Starting it off right.